This is the 2025 FOREX Trading Empire Mentorship Program, Lecture 36. The topic for this lecture is weekly review. I'll be doing a review on Hero USD based off the past weekly review. In this weekly review, I'll be pointing out the steps in which you'll be using to get to a trade setup. We have talked about the elements to a trade setup on past lectures. You guys know the elements to a trade setup. So in this weekly review, I'll be trying to point out the steps in which you'll be taking, when you should wait and when to act on a setup or on a trade idea, going through the Hero USD previous week chart, explaining from the bias we determined from last week weekly review, doing a continuation from that bias and explaining what is my thoughts going further and what I'll be anticipating in price going further. On the weekly chart of Hero USD, last week I talked about me looking for higher prices for price to run this swing high, which is the buy side liquidity. Because last week I talked about this retracement. If you have watched through last week's video, I talked about this retracement back to this order block where price traded through this proportion order block to run as a sell side liquidity, came down to this order block, a conservative down close candle before this up move. And this is the same level to a 50% price range, which I identify on the previous weekly review. Price came below the zero point 0.5, which is a discount price to a discount order block. And I told you guys that I'm anticipating price to go for the buy sell liquidity because after a run on this sell side liquidity, price created a swing low, which is this low. And the next run liquidity, where price already took out an internal liquidity, the next run liquidity is to see price go for the buy side liquidity. As long as price is still gravitating higher, this is my bias for price to trade back to a premium price, take out the buy side liquidity, and go for this buy side liquidity. So last week, price open, came down, took out previous week low, did a retracement back to the previous week high. You can see how the week came down, took out the previous week low, traded back but did not go for the previous week high. So you can still call this a CRT where you'll be anticipating the next candle to lead to a continuation with the 4-hour trend trading higher because we're trading the weekly profile, which is the weekly bias. And the rules for a weekly bias is that we're using the weekly to determine our bias and our narrative to know what is going to be the next draw on liquidity. Second, we use the 4-hour. We only trade when the 4-hour trend is aligned with the weekly narrative and bias. So when the 4-hour is aligned with the weekly narrative and bias, that's when we look for continuation. And whenever price retrace to a discount or retrace to a 4-hour point of interest, then we look for our entry in the 15 minutes. We want to see the trend align with the weekly, then we look for our entry when the 4-hour is in a discount point of interest or is in a point of interest that is well confirmed to give us a continuation trading higher, which in a classic buy order, buy order flow, price we were expecting fair value gap, buy side, sell side inefficiency, trading higher, and we're expecting order block that would lead to price forming more support to create higher prices trading higher. So you want to see the 4-hour trend stay in those states of delivery to price deliver to your targets. On the 4-hour time frame, here's the opening price, which is this blue line representing the opening price. So I talked about showing you guys the steps in which you'll be aligning the 4-hour with the weekly. Talking on how to mark your charts on a 4 hour time frame. Now, on the recent weekly review, I didn't go into much details into how to mark your price and what are the scenarios. I did talk about the two type of trend you'll be expecting, either a trend continuation going higher or a retracement down to a discount liquidity before trading higher. Now, in this review, I'll be showing you guys how to mark a chart correctly. First, you look at the opening price. Now, let's take it as an example. The price haven't printed this side of the chart, which is this week. We are only focusing on this week, not this week first, because we are trying to mark out the point of interest below the opening price and above the opening price. Below the opening price before this candle traded to this 4 hour fair value gap. This is a 4 hour fair value gap. After the 4 hour fair value gap, below the 4 hour fair value gap, we have 4 hour order block. This should be a 4 hour order block. So we're going to call this OB, 4 hour order block. After the 4 hour order block, below the 4 hour order block, we have a swing low, which is the previous week low. Now, these are the areas where if price were to retrace to either of these areas, these are the areas we'll be looking for price to support from, looking for price to respect to continue the trend trading higher because our bias is to see higher prices. So these are the points of interest. This is how you mark your points of interest before the week opening. And you can mark it inside the week, depending on the time you're looking at your charts. Maybe it's before London section on Monday or the night after the opening price of the week, which is on Sunday. So whatever way you choose in marking out your chart, as long as you know the liquidity below the opening price and above the opening price. Above the opening price, we have previous week high, which is our draw on liquidity. We're looking for price to run the previous week high, and you can still mark out other week's high, which above this high, the next drawn liquidity should be the buy side liquidity from the weekly time frame. So we already know that if we're able to take out this weekly high, the next area I'll be looking for price to trade to should be the buy side liquidity. So price open, traded to the 4 hour fair value gap. Now this is your first area for you to look for higher prices, to look for your entry on the 15 minutes and the 5 minutes. Now, if you can't find a clear shift in structure from the 15 minutes, you can use the 5 minutes as long as you know how to place your stop correctly at a recent swing low before the high, which I will explain more once we get to that example. Price returns to the first 4 hour fair value gap. This is the first area you should look for an entry, anticipating price to go for previous week high. Price failed, traded lower, traded to this other block. Now, the other block should be the second level for you to look for your entry. The point is that you're anticipating one of these points of interest to lead to a reversal going higher. At this point, price is an internal shift in structure on the 4 hour time frame, took out the previous week low. After the order block failed to support price, the price to trade higher. And this day was aligned with the unemployment claims on Wednesday when price traded lower on the 27th of August. There was an unemployment claim. You can check that on FOREX Factory. Price traded lower, took out the weekly low. They announced the news after the high impact news. Price kept trading higher, did a shift in the 4 hour time frame, then led to this continuation. So, what are the areas you should be looking for your entry on the lower time frame? So, the first area should be the moment price retraces to the 4 hour fair value gap, you look for a buy. The second is the other block, you look for a buy. And the last area should be after price takes out the previous week low or previous week high, is to see if price were to reverse, mostly on a daily basis. These are the times where you can still look at your daily bias to see if the daily bias is aligned with that idea, where price takes out the previous day low or previous day high to align with the idea and is fully aligned with the perspective of anticipating higher prices going higher. Just for more confirmation, but you can still use the weekly and the 4 hour, because if price were to run the previous week low, you just wait for a 15-minute shift to catch that first move that will lead to the shift in structure, which should be your target should be this buy side liquidity as your first trade, because this is the swing high after price from the swing low, taking out this previous week low. The next drawn liquidity should be this buy side liquidity if you're anticipating price to trade above to the opening price to go for the previous week high. Now, price did not actually reach there before on Friday, but there's still enough move after the run on the previous week low, leading higher to that price action. So we're going to draw back this fair value gap a little bit back, the 4 hour fair value gap, but you know the 4 hour fair value gap is still there. First area for your entry, second and third. Price respected the third area, led to higher prices. We're very conscious about the 4 hour trend. Now, as soon as price did this shift in internal shift in structure from the 4 hour, I wouldn't be looking for an entry if price were to take out this low. I will wait for price to run a previous day liquidity. Sorry, this example is a previous week liquidity, which is this week. And the next previous week liquidity is this swing low, which is the previous week low. Those are the areas you look for price to respect before trading higher. If not, you'll be caught up in a trend on the wrong side of the trend where if this bias was to keep on trading lower, you will still be looking for an entry to buy going higher when the trend is no more aligned with the weekly bias. So look for your entry, higher prices. Your target should be the buy side liquidity. After around the buy side liquidity, price haven't traded to the previous week high or go below, sorry, or go above the previous week opening price, this week opening price. So price traded higher, left the 4 hour fair value gap. Remember, you want to see every 4 hour fair value gap support price, and price should not go below a 4 hour swing low. If price were to go below the 4 hour swing low, you can either look for a continuation where you are using the daily to realign yourself with the bias, but you want to see price stay above each swing low, not trading below each swing low. So which means you'll be looking for a continuation from the 4 hour fair value gap. Price traded lower, 4 hour fair value gap laid the last support, trading higher on Friday. So when we go to the lower time frame, these are the areas we'll be looking at. Looking at the trades which you have gotten into the trade, taking the losses, as long as your bias is still aligned, you look for more trades. So from this first entry, second entry level, and third entry level, we're going to the 15 minutes to look at those level before the trend continuation, the 4 hour level. On the 15-minute time frame, I'll be looking at each individual days where price retraced to those points of interest I mentioned on the 4 hour time frame. But here's the first level where price did the retracement to the 4 hour fair value gap, which was on Monday. You'll be looking for a trend continuation on Monday to see price go for the previous week high. This should be your overall target on Monday. Now, on Monday, before London section, if you are to use the daily bias, sorry, the weekly bias, you are bringing down that weekly bias to align it with a daily perspective. Now, price is inside a 4 hour fair value gap, and we're currently at London section. Where should be your bias to trade this London section is to anticipate higher prices, and the 15-minute trend should be your trend to anticipate price to respect those price range to deliver higher prices on a buy side delivery going for the previous week high. Now, before London section, price did this internal shift before a complete shift. After the shift, this should be your first entry. You can use the fair value gap as your first entry. Your stop should be the swing low, and your target should be the previous week high. You can see how price traded stopped you out. Now, this is your first trial. Remember, as long as prices stay aligned with your bias, you can still take on these losses, knowing that you're still following your plan. Here's the first losses. Then price came back, took out this Asian low, which was still inside the 4-hour fair value gap. Remember, it's still valid to anticipate higher prices, even if you take a losses from the first section, as long as price trades back to that first low price created when doing the first shift in structure, there's still a chances of price trading higher. Although in this example, price traded lower, took out the previous, you can say takes out Asian section low, but traded deep into the fair value gap. This should be your entry. Price traded up before the shifts in structure, price already retraced back to this fair value gap. So this shouldn't be an entry. And there's no other fair value gap to use as an entry before the close of the 10 a.m. candle on Monday. So this shouldn't be your entry because price from this fair value gap, there was no shift in structure before price retraced to the fair value gap, respected it, and traded higher. When later came back, traded through, took out the swing low. So always pay attention to enter on a real shift in structure. So let's move to on Tuesday. So before on Tuesday, price traded deep into the 4-hour fair value gap, traded to the 4-hour order block during the Asian section. Price came back to the 4-hour order block during the Asian section. We expected it did a shift in structure. We got to London section. Now London section is still inside this 15-minute swing low and swing high. So this is a great opportunity for you to look for a buy. Now, in this example, it didn't work out, but I've seen many examples where price will just use the trend from the Asian section as a continuation to trade higher, mostly when you are using the weekly bias. So back to the fair value gap, this should be your entry. Remember, when we got to the London section, price was still inside the entry level, so it was still a good chances for you to look for an entry, and your target should be the previous week high. Or you can target the previous day high. Now, you can target the previous day high when there's the 4-hour swing high on the previous day. You just target the 4-hour swing high on the previous day high. I think they're quite the same, but you should know your next target from the 4-hour time frame. It should be this high. It should be your target. Clearly, in this example, you can see that price traded lower, took out the swing low. After you run on this swing low, price did an internal shift, and here's another setup. Now you're down by 2% in this trade, but here's another setup. Let's mark out the setup. Stop at this swing low. Your target should be the same target because you're anticipating price to go for this high. Price only came back, took out Asian section low, then a continuation trading higher. The New York section should have provided a continuation trading higher if price were to trade higher. But price didn't have any intention of expecting the trend trading higher. So price did a turn, took out the sell side liquidity. Now it's okay to take your losses, to take your losses now and then on price because we are working on probability. And in this trade plan, if you are to hold a trade, it should be at a minimum of a 2-hour trade. Do not take any trade below 2 hours. I've tested it. When you take a 1 to 1 hour trade, there are some times where it do affect your PNL once you go into losing streak taking a 1 hour trade because you need your 1 hour trade to be above 50% win rate when taking a 1 hour trade. And based on my back testing, all trades still have the same probability when it comes to the entry level, not how far price will trade. So taking a 1 hour trade, it will affect your PNL. So stick to a 2 hour trade at a minimum. With the first trade was a 2.35 hour, the second trade was a 2.5 hour, and the third trade was a 2.2 hour trade. Now moving to on Wednesday, price traded lower. Now on Wednesday during the London section, price was still at this area, which for you to look for a continuation, you need to see price go for the swing low to look for a continuation trading higher, at least the previous day low before anticipating higher prices. Because price might still respect this order block if price haven't gotten to the mid-range of the order block. But price traded lower directly, traded through the order block, took out the swing low during the New York section. During the New York section, after running out the swing low, which is the previous week low, price did a shift in market structure. Now, for your target, you can use either the previous day high or you just use the next 4 hour swing high, which is this buy sell liquidity I marked from the 4 hour time frame. Then this should be your setup. And you can see how price delivered, and this is a 6 hour trade. Now you took 3 losses before this trade, so you'll be up by 6 hour at this point. You can see I followed the step by step, going through every individual days, which I've told you guys that there's a Tuesday and a Wednesday setup. Those are the prime days for you to look for your weekly entry when you're using a weekly bias. You need to align that bias with a daily perspective where price traded down, took at the previous week low, the 10 a.m. reversal gave us this entry, went total opposite of what price did from the opening price of this daily candle before delivering to the 4 hour swing high, giving us a 6 hour trade. After that setup on Thursday, price did a complete hit on that target before New York section to complete the 6 hour trade. Now, on this trade management, there's a few questions some students have been asking me on how I manage my trade. Now, how I manage my trade is quite different, but I've back tested it. It still works for me. When I have a high target like this, where price is traded to a 6 hour, when price trades to a 2 hour trade, I move my stop to break even. Once price at 2 hour, I move my stop to break even. Then when it's at 4 hour, I take half of the position. That is, if there's still more potential for price to trade higher. Once it's at 4 hour, I take half of the position. Then I hold the price trades to my target or trade against me. Remember, if price were to trade against me, I'm not losing any money from the trade because I've already traded my stop to break even and I've taken out half of the position at 4 hour, which is a 2% gain. Is already above the 2 hour trade minimum trade. So holding up for higher prices is like leaving a trade open with no risks and having a potential to catch a high move like this. So that's the reason I do leave a trade open, mostly half of my initial position. On Thursday, price traded higher from the 4 hour fair value gap. Then on Friday, retracement to the 4 hour fair value gap. Now, on Friday is not an ideal day to look for a 15-minute entry, or let me just say to look for a weekly bias entry. But this is a continuation. There's still a potential for you to catch a trade, but mostly I do advise you guys to reduce your risks when trading a weekly bias on a Friday because there are some chances the price will not trade to your full target. It will stop at midway and price will close. Then the next week might trade aggressively to your initial target. But holding trade over a week is not something I would advise you guys to do at first. You should stick to holding trade only for a day not holding trade to the next week. You can hold to the next day, but to the next week, I don't currently advise it. Due to the current market condition, there are some chances that price will open with a big gap. And if that price were to gap against you in your brokerage account, you might see a lot of slippage in your account, even if you did set a stop loss. So on Friday, price traded to the 4-hour fair value gap, did a continuation, failed to trade higher, traded lower, took out even section low before finally trading higher. Now I did trade this day. I used it as a daily bias, and I will explain the individual trade I did took in this trade on Friday. Now I used the 5 minute because it's on Friday. I'm trying to get on a short price movement. I'm only using the weekly idea as a daily bias. So the first setup was price traded to the 4-hour fair value gap, and there's a 5 minute trend trading higher, shift in structure that continues the trend. And here was my first entry. Now, I did take partial, which I explained, taking partial at 4 hour, moving my stop to break even before my initial target, which was around a 9 hour trade. But price failed to trade to the area. It was around, I think, 7 hour that price did a retracement back. But I already banked in 2% because I closed my first trade at 4 hour. So this was my first setup, which taught me at the break even, and I've already locked in 2% from this trade. Now, the second retracement back to the 4-hour fair value gap, I was really thinking about not taking the trade at first, but once the news came out where price failed to trade lower to go for the swing low, then there was a 5 minute shift that gave me the extra conviction of price going higher. So I was convinced by this shift in structure on the 5 minutes with the fair value gap, the price is trading higher. Remember, the weekly bias and the 4-hour trend is giving you the perspective. The narrative that you got from those time frame will give you the perspective on what to look for on an individual days, where you can easily take a risk on using the 5 minutes or the 15 minutes for your entry, as long as the bias is still the same and you know how to manage your trade correctly. So this was a 3.5 hour trade. This was a 2 hour trade because price did not trade to the full target. But you can see the process gradually. You can see we don't win all the time, but when we are right, we are locking in a big percentage to cover up our losses. We took 3 losses, 2 win, and 1 break-even trade, which we already locked in 2%. So with the 3 losses, we have 3%, 6%, and we have 8.5% profit gain. Just 1 week trading one currency. I told you guys many times on live calls that you can easily trade one currency if you know what you're doing. If you know what you're doing, and you can easily use that bias from your weekly bias to apply to a daily bias, to apply to the interweek bias or an intraday bias, you can easily trade one currency and you still locked in the minimum percent gain I tell you guys to look for, which is the 4%. When you were a beginner trader, the first profit gain you should aim for should be 4%. Aim for 4% your first month, or going further, 4% can give you whatever you want in trading when you know how to apply it correctly. You just need to increase the capital where the 4% will worth a lot in your account. So only 1 week you're already locking in a 8.5 hour trade using the right risks and the right trade management. So that is it for this video. Going further, I'll be learning in on daily bias, explaining more about daily profile, be doing daily reviews. But if you guys were to understand this 2025 lecture, I'm mostly talking about weekly bias, weekly narrative, and daily bias, daily narrative. I'm only talking about two concepts. It's the power of three on learning how to anticipate the next weekly candle or anticipate the next daily candle and applying power of three with the right time frame to take your trades or the right time frame correlation, how to combine those time frame, multiple time frame to have a well planned trade plan. So that's it for this lecture. See you guys in the next lecture.